Welcome to the STR Data Lab.
Hello and welcome to the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined today by our first two-time guest, Ben Gross. Ben, CEO of Minty Living. Welcome.
Thank you, Jamie. I'm glad you didn't tell me that ahead of time, that I was the first returning guest on Data Lab. Otherwise, I would have had more anxiety about it. I didn't realize that was the case.
So it's our 93rd episode, and I can't believe we've gone this long without having a repeat guest. So it's great to have you back.
Thank you very much. It's a pleasure to be here. Very excited to talk about all the amazing things happening in the industry today.
Yeah. So last time we talked a lot about Minty Living, about how you sort of started the company, your sort of history with your wife, co-founder. And maybe we'll just, for those that haven't listened to that episode, could you just give us a baseline on who you are, what is Minty Living, just the overview as we get going today?
Absolutely. So Minty Living is a combined technology and hospitality company. My background is mathematical finance and software engineering. And when we moved down to Atlanta in April of 2020, I thought I had given up a lot of that. And after we grew to 30 units, I realized the existing technology stack in the space had some pretty big glaring holes. So we take a lot of our profits and we pour that back into technology development, because we think to really scale, you've got to have plugged some very sizable holes that currently exist in the market. So at Minty Living, we really pride ourselves on consistent visual aesthetic and incredible guest experience with hundreds of reviews on Google. We have 4.9 Google stars. We're Airbnb superhosts. We have net promoter scores of 77 with our guests, and we represent about 180 furnished units in the Metro Atlanta area. We are Metro Atlanta's largest furnished rental provider, and we've done that in just about the past 4 years.
Having known you for a couple of those years, and it really has been amazing to see the growth. Some of the things that stand out to me there is having 180 units and being a superhost is like almost unheard of at that scale, and be able to get a 4.9 rating, and of operating in the Atlanta market, which has been so tough, as I'm sure we can talk about with the writer strike and just the swings in demand, and especially for short-term rentals, has been wild. New regulations proposed, enacted, maybe not yet enforced. Impacting the business. So how has operating in this environment been for the past few years?
You know, I've had many people approach us and say, I really love the business model of vacation rental managers. And I kind of always chuckle to myself, because it's a clear indication they don't really understand the business. It has very much been a lesson in finding the highest priority problems to solve, and then the most repeatable upstream way to solve them, and then rinse and repeat. To your point, one day you're figuring out a technology integration glitch between your PMS and your vendor management platform, and the next day you're figuring out how to fill out STR applications via PDF at scale in a programmatic way. They could not be more different problems than you deal with on a day-to-day basis. And I think very candidly, because of the breadth of the problems that vacation rental managers deal with on a day-to-day basis, it's been one of the clear reasons that technology companies have had such a difficult time entering into the industry and really growing and scaling. In the 2020 era, we saw hundreds of millions of dollars of venture capital pour into the space with this combined tech-enabled service provider. And we have seen many of those providers go out of business because the technology really was not able to provide the leverage that's needed to scale and to be able to do it profitably.
So, and that's an interesting question there of tech-enabled service providers and the tech allowing you to scale. And that tech either being, and what I think a lot of these companies built in-house, or what many companies sort of outsource and sort of buy through tech vendors in the space. So how do you think about the sort of build versus buy and like the ability of tech to allow you to scale?
Yeah. No, it's a very challenging question to answer on the day to day. One of the biggest challenges that we foresaw in the beginning is that this business is very much like dozens, if not more than 100 little assembly lines. You can think about the turnover and a guest checking out of the unit and getting that unit cleaned, to an owner coming into the top of the funnel and then understanding what your business is and then being onboarded. There are dozens and dozens of these little assembly lines. And the piece where I really saw the biggest gaps were around this guest operations and guest services type of assembly lines. And so if you look at any assembly line, and this goes back to the world of technology, you want there to be this concept of observability, right? How do I know that an assembly line is broken? Well, it's producing less widgets, or the widgets that it's producing are in some way defective. And so, in a world that is largely taking place in physical space, it doesn't lend itself naturally at all to an assembly line mentality. And yet, that's exactly the type of mentality that we need to have to really be able to identify and scale and upstream these issues. And so, when you bring up this superhost status with 180 units, which Airbnb is going to have its first ever host conference, and they've asked us to be on a panel because of exactly what you're saying, where it's very rare to find a large provider with this level of quality and consistency of guest experience. We really look at building technology around where are the physical assembly lines happening in this business, and how do we then try to build observability, or the ability to measure these processes and how they're doing at scale. And so that's been a huge data architecture push. The entire way that we ingest and store data from these physical processes has been a pretty massive lift.
Yeah, can you give some other examples of ways that are things that you're measuring and how you're analyzing those measurements?
Absolutely. So we're actually looking at things like how long certain things take. So we can have somebody who is cleaning a property. We can have somebody who is changing a light bulb. We can have someone who is staging the property and making sure that cleaning looks great. We have all of these different functional areas and specific vertical tasks defined, templatized, and measured across the entire system. So we can take any vendor who wants to come in and say that they tell us that they're a great handyman that specializes in plumbing. Well, we can onboard them to our system, go through, of course, all of the insurance vetting pieces, et cetera, and then begin to feed them tasks and then measure them along two dimensions. One of those dimensions is quality. So we have built this, what we call objective review process for every vendor. So if I'm a cleaner, my objective review is the person who's doing the quality assurance after I finish. If I'm the quality assurance associate, the objective review is the guest coming in and telling me how clean the unit is and how well stocked it is. If I'm the maintenance technician, then my objective review is the guest saying, your toilet was just fixed. How great of a job did Jamie just do? And so we can then take those quality reviews, which are one of the dimensions that we evaluate the efficacy of a vendor, and the output. we know when they started that task, we know when they stopped it, and we can now compare their throughput to the distribution of other people that have resealed that toilet. And we're like, wow, check it out. Jamie's actually incredibly high quality. The person gave him a 5 out of 5-star rating and talked about how personable he was. And he actually did it, 5.5 minutes faster than the average. So now we have these dimensions that we can really evaluate vendors, which again goes back to that observability.
So I would suspect you add all those things up, it really helps in terms of operational efficiency of your ability to have the best vendors to build out great business efficiency that would eventually help profitability. So, how do you think about overall profitability in this industry and the ability for even and vacation rental managers, urban operators to operate at scale in a profitable way? Because and you just watch the public companies out there and Vacasa, Sonder, and we just saw Selena and maybe a hybrid go under of like, it looks to be tough to do at scale profitably.
Yeah, it's this question to me 14 months ago or 12 months ago, let's say last year this time, I was not convinced that profitable urban operation at scale could actually be done. And it really was through our evolution. So not hiding any facts about what our intentions were. I mean, we set out to build a scalable operator focused on the urban environment, and we went to go raise capital in March of 2023, right when Silicon Valley Bank collapsed. Timed that one perfectly, and so we had to completely change and reorient the focus of what it was we were doing. And in 2023, I was not necessarily convinced that we were going to be able to achieve and reach profitability. And it has been a massive, massive effort, an incredible effort of our team, an incredible effort of persistence and perseverance. And so we get into this world of really bifurcating. Okay, let's say we're dealing with somebody who's got, let's pick kind of the magic number. So you take the urban markets with your incredible data and 75% of managers, and this is across the board, but 75% of managers are managing less than 36 units based on the data that I pulled around that. So I think what you find is you can manage complexity when the sample is small enough. And as soon as you get past a certain level, it becomes very untenable to manage. So you have either mom and pops that stay very much under this threshold where complexity starts to balloon, which in my experience was 30 and, in the data is 35. And you then start to say, okay, well, how do we then operate from 35 units to 3,500 units? And I think that a lot of the way that these providers, when they first looked at scaling, so the Vicasas and the Sonders, it was very much about, okay, we need to grow. We need to grow. We need to scale. We need to make sure that our venture backers are satisfied with the growth that they're seeing, but they didn't solve that complexity issue. And you really have to solve that first. Steve Schwab has a great phrase that I was talking to him at the last IMN conference that he said, when you're going through a military maneuver and you try to flank an enemy, is you take your force and you divvy them up from one of you to two, you're not creating a situation that's twice as complex. You're creating a situation that's 4 times as complex. And if you then split again into 3, it's not 3 times as complex. It's 9 times as complex, right? It's an order of magnitude. It's not a linear function. And companies that tried to scale to multiple urban centers without first taming the operational complexities became overwhelmed by that order of magnitude complexity growth and we're never able to solve the profitability piece because you're dealing with your O of N complexity. How can you possibly think about profitability?
Yeah. So, and we were talking before about and sort of the challenge in terms of this revenue environment we've been in. Like you can't get around, especially on the urban side, that we've seen, and even industry wide, that we've seen 2 years of declining RevPAR. We've seen occupancies decline pretty substantially. We've seen overall listing growth as an industry still pretty high. And while we were talking, I just ran the numbers for Atlanta, and I'm sure you have these on the top of your head, but 2023 looks to be like the worst year ever for Atlanta performance on a revenue per available listing basis. So when you think about and operating your business and the complexity of it, like how much was it just market forces just really pushing against and your desire to scale and find profitability during this time?
Yeah, there's no question that I think macro can always overwhelm. And with my background in as a quant and in investment management, it just always reminds me of the don't fight the Fed trade, in the 2000s and beyond, where people would have these great ideas about macro this, and of course everything makes sense, and the Fed would just completely run you over. And I think that you look to an owner. So Minty Living provides complete underwriting for any owner coming in the door. So we'll take your cost, your overhead, the projected revenue, which is very much our data around revenue forecasts we know that we're going to be able to achieve, that include vacancy, et cetera. And we'll fully underwrite any potential property. And when those numbers begin to fundamentally shift because of what's going on in the macro environment, it changes who your buyer is. So in 2020, there was a competition that was going on. The way that I phrase it is there was a competition between an investor who was looking to maximize the yield on their investment property and the parent who was looking to acquire utility that was the correct home for their family, for where they wanted to live, and the right schools in the right districts. And there was a very real competition that was going on between those two very different user profiles. And what we have seen over the last 2 years is the investor, and I'm speaking very much about the Atlanta market right now. So just to be clear, I'm not making a commentary about the global user profile. But here in Atlanta, we have very much seen the investor take a back seat to the desires and the needs of the individual seeking utility for his family or her family. And I think that's been a very interesting sea change that's taken place, which, to your point, has very much been about the macro forces, as we have seen declining RevPARs in concurrently when property prices continue to go up. I mean, Atlanta is the number one city out of the top 10 cities since 2016 around median price growth for properties. So it's been this extremely challenging market where investors comprised a very large proportion of our owner base in the beginning. And that is now shifting. And we're seeing a different profile of owner coming into the space. So the macro forces very much have been the driving force, I think, in trying to figure out how to maintain profitability in a market that's changed like this.
Yeah, I mean, and maybe to our folly, but and we've been forecasting the industry now for about 3 years. And sort of after I came into AirDNA, I'll tell you the number one forecast that we've gotten wrong is supply growth. And to your point around fighting the Fed, when looking at the data after sort of the peak in 2021, getting into 2022, interest rates going up, home values and continue to rise, and industry performance declining, our theme at that time was investability was reaching all-time lows, and that supply should slow and start to slow pretty substantially because the investment environment just in most markets for the average investment just didn't look attractive relative to history. And so we'd expect some slowing of supply growth. What did we see through 2022? And was supply continue to accelerate? Only in the back half of 2023 did we finally see it start to slow. And now we're seeing it slow pretty aggressively across the country and even start to turn negative in urban markets overall, and especially in certain urban markets, even excluding New York. So when you think of how this market now has shifted and maybe investor sentiment has shifted, how does that change your outlook for growth for maybe when you think about the overall industry, and how do you think about Minty Living over the next couple of years?
Yeah, the piece that you bring up around the available listings, I think is something that you guys certainly publish about it, but there's not enough pervasive information out there for people to really gain a sense about what's going on. Certainly in Atlanta, we are seeing the available listings decline. And that has been, I think, to your point, in urban markets across the US, we are now beginning to see that supply growth roll over and beginning to decline, which is a welcome sign,
I
uh,
bet.
which is absolutely wonderful. That certainly lends itself to a thesis that the capacity to operate profitably at scale with brand differentiation may be a viable thesis in the coming 5 to 10 years. I think that the declines in RevPALs still lingers as we see this rollover in supply. So even though, and I can look at my numbers that I have for Atlanta, but even though supply has been declining for roughly the last year and a half here in Atlanta, we still aren't seeing the pickup in RevPALs. We're just now beginning to see this pickup in RevPALs. So that means there is this kind of delayed effect of when we begin to see more appealing revenue per unit begin to take place. And you really have to take into account, obviously, the economic cycle as well. If you look at the current indicators for the NBER, the only thing that doesn't look like a recession in the chart is essentially the shaded gray area where they say, oh, we're in a recession. I mean, all of the leading economic indicators for the last year and a half have very much pointed towards feeling like a recession for the rest of the country. And so to what extent are we seeing softening desire for discretionary spending at a time when we're also seeing lower RevPAR? So it is very much all part of this bigger picture that is a more challenging piece to try to time from a quarter over quarter basis. But I think when we look at the overall trends, I mean, we've looked at the available listings piece, and it's kind of a 4-year, 5-year type cycle that we see, and it's only 2 cycles, so it's not a huge sample size, but I think it's an encouraging sign over the next cycle. It's challenging to try to determine the inflection points that we're going to see those coming back, but overall, I do think it is a positive trend in a positive direction.
Yeah. So looking at the data in Atlanta, yeah, we'd seen 27 consecutive months of declining RevPAL, which is crazy.
Crazy.
And then June and last month and was the first month that it was positive. So could that be a trend? And that's just urban areas of Atlanta. And there is a different, as you probably know, a different trend happening outside of Atlanta. You know this maybe more than most. Regulation even though not enforced, do you see that being a factor as you talk to investors of just the uncertainty out there? And I think that uncertainty can play in both Atlanta and a whole lot of markets. I mean, we've seen what happened in New York with essentially an outlawing of short-term rentals in the market, 20,000 listings sort of disappearing overnight. And we see and really restrictive regulations in cities like Los Angeles, Boston, Chicago, Philadelphia that make it really hard for urban operators to continue to operate? Or is it just investors looking at the numbers and saying, like, not only does this not pencil, like, I can't even like make the numbers work over the next 5 years. So no, I'm not an investor at this time. And does that change your thesis about being in Atlanta or trying to grow in Atlanta long term?
Yeah, it's interesting. I think again there being a couple different undercurrents that are impacting things. When you look at the available listings for Atlanta, you see this interesting inflection point when they first passed the ordinance. When they first passed that STR ordinance, you see this interesting inflection point. And in my conversations with institutional investors, that certainly gave them a certain amount of trepidation about entering this market. And so I think the initial rollover that we saw around supply growth was really around institutional taking their foot off the gas and saying, okay, this is not a market where we can confidently operate anymore. Interestingly enough, I think the tail portion of continued supply attrition has been very much about the declining RevPARs that we have seen, because there are smaller developers that have 5, 10 units that they essentially every year bring homes onto the market or multifamily onto the market. And they say, you know what? I started zero every year as a developer. Why don't I just, take 10% of my inventory and turn it into an income generating vehicle? So I look at them as kind of a class down from your bulge bracket and larger institutional investors. They're still in the game. They're very much still a part of it. And so the confluence of big institutional stepping out and then other people further exiting the market because of reduced RevPARs, it's been a fascinating case study here in Atlanta of what a fully unregulated urban market might look like. So I think there's, the invisible hand of the market, your Adams view of things, which is that to a very large extent, the laws of supply and demand and of price very much drove where we are now around supply. And that's, I think, a very interesting case study to be used as a lot of these cities look at the regulatory side of things and whether all of that makes sense. I think that our view of things at Minty Living, we have always combined our demand profile with extended stay bookings, i.e., or sometimes called medium term, which are 30 days or more. Those booked nights make up roughly 2/3 of our overall bookings. So I think that is a way to ensure that you are conforming to whatever specific type of market you are dealing with. But there is, I think, tremendous opportunity for these local governments, these city governments to work hand in hand with short-term rental operators in the short-term rental market. I mean, my disappointment's that we pay hospitality tax just like we're a hotel, but we get none of the marketing dollars that hotels get when conferences come to town or things like that. So I think there's a lot of very interesting ways that we can collaborate with cities. And to your point, the regulatory framework and how it's going to shake out in urban centers, I think, is another one of these longer cycle issues that really hasn't played out to where it will in the next 5 years.
Yeah. So I know you're looking at data constantly. You run a company that and is tracking everything. Is there any other sort of interesting data points that you're seeing that are sort of shaping your thinking right now?
Ironically, one of the one that we're really looking at very carefully is how much money vacation rental managers are spending on their technology. It's this very interesting case study where technology is failing to provide leverage to the people that buy it and that use it. Coming from the investment management world, we saw this incredible application of leverage through technology and data. In the 2000s, I could be a remotely bright person. I could code, I could understand data, and now I could put together these models and these different trading algorithms and really start to compete with some of these larger bulge bracket firms that used to require teams of MBAs. And a lot of the quant shops that have come out of this, like AQR and Two Sigma, and these, these really were based on this concept of how leverage is applied to investment management. When you then shift the focus and look at the vacation rental management world, I think it's a very interesting case study of failed application of leverage for providers, because we still see that population of 26,000 vacation rental managers, and 35%, 35 units are being managed by, 75% of the population, 35 units or less. So we are becoming very curious about the amount of money people are spending on technology and what we would call optimal operating formation. So one of the reasons that a lot of these technology companies focus on this highly fragmented market is because people do things so differently. So I'll sit down with a manager who's in Austin and they manage 40 units and they do it this way. You go and you meet somebody who's in Nashville and they do it that way. And yet I think every manager I have spoken to has said, well, wait a second, but if there's an optimal way for me to do this, I'm absolutely down to do it that way. And it goes back to the complexity of the business and how incredibly broad the issues are. And so we're actually looking at applying data to identify areas of operational inefficiency. So if I plug into a vacation rental manager's data, can I then look at elements of revenue management optimization, operational efficiency, human capital efficiency, and can I then bifurcate their business and identify areas that are most advantageous for them to begin thinking about further improving and making efficient. So we've gone very much to a different side of the fence, which is really around business efficiencies through data. So that's what we're looking at now.
That sounds really interesting. And being on the vendor side of working with a lot of large vacation rental management companies, and we look at like how we are able to scale and get more from our customers, and where as they expand, they have to spend more with us, or in some ways, like we've got one subscription, and no matter how many listings you grow to, like it scales, and you probably do see some efficiencies. And then there's other companies where the cost scales per listing. So does that technology ever scale for you, or is it just an ever increasing cost that will never go down?
And I would actually take it one step further, which is as you grow, the technology becomes more inefficient. So if we take, for example, our PMS and our vendor management platform and our guest experience app, let's say that manages IoT. Now, as we grow, you find these piecemeal issues of integration, or guest verification isn't working, or, oh, look, the fees aren't turned on for these specific listings because of some crazy nuanced bug that was very easy to find when you had 20 listings. It became very difficult to find when you have 200 listings. So this linearly increasing cost of technology subscriptions, I see as one of the greatest impediments to people being able to thoughtfully scale. I think there is a reshaping of the way that technology is sold. There's, in the world of AWS, if you think about the way that cloud computing changed the way that things were priced, it became based on API calls. I could spin something up on AWS and now it's per API call. So they get you kind of hooked on the sauce,
Yeah.
but then you're there
Yeah.
versus, oh, I need to go and buy servers, right? I mean, the amount of upfront cost is astronomical. That type of innovative pricing has not been discovered yet in our industry. That, I think, is a huge inhibitor of solving the fragmentation issues that we see. So that's very much something that we are thinking about and looking for the solutions around, and whether those solutions are in fact shareable.
So maybe starting to wrap up a little bit, maybe a big theme that I've heard from you today is in 2023, you were, and maybe convinced that operating urban vacation rental management wasn't possible. In 2024, it's like, how can I help other companies and find the efficiencies that we found to operate profitably? So what do you think this next year is going to look like for you guys, of like, and how the evolution might evolve?
Absolutely. I think you're exactly right, where 2023 was about, I don't believe you, prove it. Let's say early 2024 was, okay, proved it.
Uh-huh.
And now it is very much about, can you take that and make that its own product vertical? We spend a lot of time with vacation rental managers. I think there are some interesting challenges around acquisition, because vacation rental managers, if you've made it to 35 units, you are a very strong-willed and persistent individual, which doesn't necessarily make you a great target for acquisition.
Yep.
It means that you believe in kind of this gut instinct, and you're willing to go to the mat and not tap out no matter what, which may be self-selecting and have a bit of survivorship bias around, well, then maybe acquisition is going to be really hard in this market, because you've self-selected the people that are going to be least likely to be excited about acquisition that's going to be a deal for the acquirer. So I think that for the next year, we are actively looking at what the optimal way to collaborate with vacation rental managers is, because the growth of inventory by 5 units per month per urban center. So if you take, the Minty Living model of growing somewhere in the ballpark of 5 to 10 units per month, and you just scale that out horizontally to, 20 urban centers, that's okay, but that's not necessarily easy. In fact, back to the Steve Schwab reference, it's O of N hard. So for this next leg of our journey, we really are exploring, are the efficiencies that we have landed on identifiable through data for new vacation rental manager providers? And can we then instrument those efficiencies for other vacation rental manager providers in ways that give them the autonomy to still be at the helm, to take those incredible qualities of being strong-willed and being tenacious and continuing to be the captains of their ship, but at the same time, ensure that we are able to, in a much more efficient way, distribute the capabilities, the data architecture, the technology, the guest experience, and the design that we have built at Minty Living in a more efficient way.
Well, and it sounds like you got a vision. It sounds like you've tested it. You've got a plan. So I'm really excited to see how it goes and have you back for the third time and talk about it next year. So Ben.
Wonderful. Wonderful. That would be wonderful. Thank you for having me, Jamie.
Yeah. And if people are listening, want to reach out, learn more, how do they contact you?
Yeah, I'm on LinkedIn. You can find me. I'm just search Minty Living and I pop right up. My email, Ben at mintyliving.com. And those are the two best ways.
Awesome. Ben, thanks so much. And I'll see you around Atlanta.
Thank you, Jamie.